A retired school teacher in Ohio, 34 years in the classroom, walked away with a pension of $1,840 a month. That's it, after 34 years. Around the same time, a FedEx driver in his mid-50s, no finance degree, no inheritance, no side hustle, started collecting $4,700 a month from his investment portfolio. Not from selling anything, not from working extra hours, just from owning stocks that paid him automatically every 90 days. The difference between those two outcomes wasn't luck and it wasn't timing. It was one specific system, started about 25 years earlier, that most people walk right past because it sounds too slow to be interesting. This video is about that system. Here's exactly what we're going to cover. I'm going to show you how dividend investing actually works, not the motivational version, the mechanical version. The math behind how a small, consistent amount of money can grow into $5,000 a month in income, the specific things you need to look for before buying anything, and why the most common mistake people make with this strategy actually kills the whole thing before it gets started. By the end of this, you'll have a clear picture of what this looks like in practice, the numbers, the timeline, the steps. No vague advice, just the framework. Let's start with the thing most people think they already understand, but don't. What a dividend actually is. When a company makes more money than it needs to keep operating, it has a choice. It can reinvest everything back into the business, or it can share a portion of those profits directly with the people who own the stock. That shared profit is called a dividend. You don't have to sell your shares to collect it. You don't have to do anything. You simply own the stock, the company makes money, and they deposit a payment into your account, typically every 3 months. That's passive income in the most literal sense of the phrase. A simple example, say you invest $10,000 into a stock with a 4% dividend yield. That means you receive $400 a year in dividends, $100 every quarter, just sitting in your account, whether the market is up or down that week. But here's where it gets interesting, and this is the part the basic explanation always skips. Dividend growth. A good dividend-paying company doesn't just pay you, it raises the payment every year. Not because you did anything, not because you added more money. The company simply decides to increase how much it distributes to shareholders. So that $400 you earned in year 1 becomes $432 in year 2 if the company grows its dividend at 8%, then $466, then $503. Same number of shares, same original investment. The income just keeps climbing on its own. And this isn't rare. There are companies that have raised their dividend every single year for 25, 30, even 50+ consecutive years. Through recessions, market crashes, global crises, the payment went up anyway. That's not a coincidence. That's a business that's genuinely growing its profits year over year. Now combine that rising payment with one more thing, and the math starts to behave in a way that genuinely surprises people. Compounding, the drip loop. Every time a dividend lands in your account, you have a choice. Take the cash or use it to buy more shares. If you take the cash, the loop stops there. You've earned income, and that's fine. But if you buy more shares, something changes. Now you own more of the company. More shares means a larger dividend next quarter. That larger payment buys even more shares, which generates an even larger payment after that. This is compounding, and it's genuinely powerful, but only if you leave it alone long enough to build momentum. Let's put a number on it. You invest $5,000 into a stock priced at $50 per share. That's 100 shares. The dividend yield is 4%, so you earn $200 in year 1. You reinvest. You now own 104 shares. In year 2, those 104 shares pay $208. You reinvest again. 108 shares, $216 the following year. You haven't added a single dollar of your own money after the initial $5,000, but the income is growing anyway, purely from the loop running itself. And here's what most calculators don't show you. Once you layer in annual dividend growth on top of reinvestment, the curve stops looking linear and starts bending upward. Slowly at first, then noticeably, then dramatically. Most brokerage accounts have a setting called DRIP, Dividend Reinvestment Plan. You turn it on once. From that point forward, every dividend payment automatically purchases more shares. The loop runs without you ever logging in. The real target. the inflation problem. Now let's talk about the goal, because this is where a lot of dividend plans fall apart, not because the investing is wrong, but because the target is too small. Most people anchor on a round number. $2,000 a month sounds like enough to cover the basics: rent, groceries, utilities, transportation, a modest but functional life. But here's the problem. You're not building this for today. You're building it for 20, 25, or 30 years from now. And inflation doesn't pause while you're investing. At a 3% average inflation rate, which is historically conservative, $2,000 a month in 30 years has the purchasing power of about $825 today. The same $2,000 buys what $825 buys right now. That's not a scare tactic, that's arithmetic. So the question shifts. It's not, how do I reach $2,000 a month? It's, what does $2,000 a month in today's money actually look like in 30 years? Adjusted for inflation at that same 3%, you're looking at somewhere between $4,500 and $5,500 a month. That's the real target. $5,000 a month sits right in the middle of that range, and that's the number we're working toward for the rest of this video. The 3 filters. Not every dividend stock deserves a place in your portfolio. Some pay a high yield today but haven't raised the dividend in a decade. Some raise it aggressively, but the yield is so low it barely moves the needle in the early years. Some look perfect on paper until you realize the payout ratio is 110%, which means the company is literally borrowing money to pay you. The framework comes down to 3 filters. Every stock or fund you consider needs to pass all 3, because if any one of them is missing, the math to $5,000 a month breaks down. Filter 1, it needs to pay you now. That's dividend yield. How much income does it generate relative to the price you pay? A 5% yield on $10,000 puts $500 a year in your account. A 2% yield puts $200. Both can work, but they play different roles. Filter 2, that payment needs to grow every year. A flat dividend doesn't protect you from inflation. You need dividend growth rate, specifically how quickly the annual payment has been increasing. A 10% growth rate doubles the payment roughly 7 years. A 15% growth rate doubles it in under 5. Filter 3, the price needs to appreciate over time because you're reinvesting dividends to buy more shares, and if those shares are declining in value, the compounding loop loses efficiency. Price appreciation keeps the engine running at full speed. Yield, dividend growth, price appreciation, all 3 together is what separates a portfolio that drifts sideways for 20 years from one that actually reaches the target.
The yield trap. Here's the thing that took a while to fully appreciate about this strategy. Most financial content focuses on what to buy: this stock, that ETF, this sector. And that matters, but it's actually the smallest part of the equation. The bigger question is, what combination of yield and growth gets you to $5,000 a month the fastest, with the least amount of risk along the way? And the answer is almost never the highest yielding option. In fact, the highest yield stocks on the market are often the riskiest. High yield can signal the market is pricing in the possibility that the dividend gets cut. And a cut dividend doesn't just reduce your income, it usually tanks the share price at the same time. This is a pattern worth understanding concretely. A major healthcare insurer that looked stable on dividend metrics a couple of years ago, strong yield, double-digit growth rate, ran into regulatory investigations, leadership crisis, and a 40% plus drop in share price. The 3-filter framework doesn't guarantee protection against that, but it's exactly why diversification across sectors and prioritizing track record and balance sheet strength over headline yield matters. The sweet spot isn't maximum yield, it's the right blend of yield, growth, and stability. Building the portfolio. 5 positions. Let me show you what a portfolio built on this framework looks like in practice. The goal is 5 positions. Each one passes all 3 filters, but they don't all score the same way, and that's by design. Some lead with current income, some lead with growth. Together, they cover every phase of a long-term window. Position 1, SCHD, Schwab US Dividend Equity ETF. This is the only ETF in the portfolio, and it's here for a reason. SCHD holds over 100 dividend-paying companies across different sectors. If any single stock in the portfolio has a rough year, SCHD is the reason the whole thing doesn't collapse. It's the foundation, the diversification layer. It carries a yield around 3.3%, a 3-year dividend growth rate above 11%, and consistent long-term price appreciation. Its role isn't to maximize anything, it's to make sure no single failure derails the system. Position 2. Home Depot. Not the most exciting name on the list, but Home Depot has raised its dividend for 17 consecutive years, and the stock itself has appreciated meaningfully over the long term, around 8.5% per year on a 5-year basis. It carries roughly a 2.5% yield. In a portfolio built for the long run, consistent and boring outperforms flashy and unpredictable. HD is the kind of position you hold through 5 market cycles without second guessing. Position 3. Lowe's. Lowe's is actually a dividend king. 54 consecutive dividend increases, never missing a raise in over 5 decades. The current yield is around 2%, which means the income feels small early on, but the 5-year dividend growth rate above 15% means the payment has been doubling roughly every 4 to 5 years. One important note, recent annual growth has slowed to around 4%. That's still above inflation, and the long-term track record is exceptional, but it's worth understanding that a high historical growth rate doesn't guarantee the same pace going forward. Lowe's is the position that barely shows up in year 1 and does significant work in year 20. Position 4. Johnson & Johnson. Every other position in this portfolio is tied to retail or real estate. J&J changes that. It's one of only 2 publicly traded companies in the world with a perfect AAA credit rating. It has raised its dividend for 63 consecutive years, making it not just a dividend aristocrat, but a dividend king among dividend kings. The current yield is around 2.2% with a 5-year dividend growth rate near 6%. That's modest compared to some names on this list, but J&J's role isn't to be the fastest grower, it's to provide rock-solid sector diversification and the kind of financial stability that holds up through almost any economic environment. When everything else gets volatile, J&J tends to stay calm. Position 5. Rexford Industrial. This is where the trade-off is visible. REXR is a REIT focused on Southern California industrial real estate, warehouses, logistics facilities. It carries the highest current yield in the portfolio at 4.7%, and its 5-year dividend growth rate is approximately 12.4%. The share price appreciation has been more modest than the other 4. An honest caveat, REXR's dividend has been essentially flat over the past year at 43 cents per quarter, reflecting some cooling in the industrial real estate market. The long-term growth track record is still meaningful, but in the near term, income from this position is stable rather than actively growing. That's the trade. REXR is the position that makes the early years feel real. While the other investments are compounding quietly in the background, REXR is already putting cash into your account every quarter. In a 30-year strategy, having one higher income position is what keeps you patient enough to let the rest of the portfolio do its job. Blended together, a portfolio like this lands around a 3% yield and a dividend growth rate near 10 to 11%. That combination, run through 30 years of consistent contributions and reinvestment, is what builds toward $5,000 a month in income. The numbers. Let's run the math on $5 a day, $150 a month invested consistently. At the end of year 1, roughly $1,800 contributed. The portfolio hasn't moved much. This is the stage where most people check the account, feel nothing, and quietly stop. Year 10, $18,000 contributed. The portfolio is growing visibly. The dividend reinvestment loop is building momentum. The difference between what you put in and what the portfolio is worth starts to widen. Year 20, $36,500 contributed. More than 2/3 of the portfolio's value at this point comes from growth and reinvested dividends, not from your own pocket. The snowball isn't a concept anymore. It's visible in the numbers. Year 30, $54,750 contributed over 3 decades. The dividend income in year 30 is approaching or exceeding $5,000 a month. The exact number depends on how each position performs, but the mechanism that gets you there, compounding dividend growth over time, is what the math consistently produces when all 3 filters are met and the system is left to run. That income in year 30 has the purchasing power in today's dollars of roughly $2,100 per month. You didn't just reach the number, you outpaced inflation on $5 a day.
The actual setup. Here's how to start. Open a brokerage account. Fidelity, Schwab, and Vanguard all offer commission-free trading, no minimums, and fractional shares. Fractional shares matter because you don't need to afford a full share of any company. You can invest $7 and own a meaningful piece of something that's been growing for decades. Set up an automatic transfer of $35 a week, $5 a day, split it equally 20% across 5 positions on the same schedule every week. Don't adjust based on market news. Don't try to time entries. Turn on DRIP. One toggle. Every dividend from that point forward automatically buys more shares. You don't manage it, you don't think about it, the loop runs itself. The setup takes about 15 minutes. The patience required is measured in years. That's the honest version of this strategy. It's not exciting month to month, but the math at year 20 is extraordinary. One more thing. Avoid checking your portfolio value constantly in the early years. In year 1, a $5 a day portfolio won't look impressive. That's not the point. The point is whether the system is running correctly, contributions going in, dividends being reinvested, positions intact. The most common pushback, 30 years is too long. I don't have 30 years. Fair, but notice what the numbers look like at year 20. The portfolio is already generating meaningful dividend income, and the majority of its value came from growth, not your contributions. The 30-year number is the full expression of the strategy, not the minimum version. Start later, contribute more. Start at $15 a day instead of $5. The framework scales. What doesn't change is the sequence: yield, dividend growth, reinvestment, time. The other objection is, what if I pick the wrong stock? That's exactly what the ETF position is for. It's why position 1 isn't a single company. Diversification doesn't mean owning 50 stocks. It means making sure no single failure takes down the system. Most people trade their time for money their entire career. The job pays the bills, and when the job stops, so does the income. That's not a criticism, it's just the default system, and most people never see an alternative clearly enough to act on it. What dividend investing builds is a second system, one that grows while you sleep, raises your income without you asking, and eventually, if you give it enough time, pays you more than your job does. It's not fast, it's not exciting in the early years, but the math is real, the mechanism is simple, and the outcome is the kind of financial independence most people spend their whole lives thinking about without ever getting specific about how to build it. The question worth sitting with isn't whether this works. The question is, what are you waiting on to start?